So I've been promising a couple beginner videos for January, and with the current trading conditions where I don't feel like live trading is really the way to go right now, that gives me some time. So let's call this the first installment of that beginner series. It won't be much of a teaching per se. It will more be around how you structure your mindset when you're coming into trading as a professional. And if you're new to trading, this is how you should have your mindset conditioned for long-term consistency. Okay. So the first thing you want to understand is that the markets are controlled by an algorithm. This is a notion that I have accepted from ICT. And if you have followed ICT over the years, then you would know that this is something he strongly believes, and everyone who learns from him has now accepted that. We've seen too many instances of this being true to doubt it anymore. All right. So the market is controlled by an algorithm. An algorithm is the one that thing that's moving price up and down. Okay. Once you have that accepted, you want to develop an understanding of how an algorithm works. All right. So an algorithm is going to, well, in this case, it's one that's going to be predicting future prices. How it does that, or how do you understand how the algorithm operates, is before price goes anywhere, the algorithm is going to look back for a reference point in time at a particular price, and then use that to determine how price is delivered along its path. So that might be a little bit confusing. So let's say that the algorithm is going to move price from this red line all the way up to this red line. At a particular time, it's going to look back, reference a range or price or a particular object on the chart, not necessarily the chart, but it's a range of price that it's going to look back for. And then based on how that range is delivered, it's going to take elements from that range and project it forward like a building block. And that's the idea of using projections, and why I personally just love using projections for not just target and objectives, but for how I frame my entire trade setups. So the most common building block, if you will, is understanding how you can use the Asian range to frame out where price is likely to move to. So this is the Asian range I use between 8 p.m. and midnight New York time. I've seen more consistency using this range, so I just stick to using that. I primarily use the bodies of the candles. So with this idea here, this is now a building block for me that I will use wherever price goes to. If I'm trying to anticipate where it's going to move to next, within this next day, that is, I will use this as a building block and stack them to measure just how far I believe price could go, right? So that's the Asian range right there. So someone asked me how to interpret or look at or understand standard deviations. Standard deviations, as used by everyone, I believe, is once you have a range, you try to consider this range as like ground zero. If this range is ground zero, how far away from that ground zero point we move can be measured or guessed, if you will, by using stacked deviations of this range. What do I mean by that? I'm going to take this measurement here and clone it like that. This now becomes one deviation of this range. So if I believe for any reason that price should go to one deviation of this range, once I stack the measurement of this range below itself like that, this area gives me one deviation of the range. And again, if you're hung up that this is where price should go to, once price goes there, and you start looking for reasons to enter. Notice I did not say when price gets here, you enter. You start looking for a reason to enter. If you're more reserved or selective in your setups, when price gets here, you won't just buy or sell. You look for what are the reasons at this red line that supports the idea that I can be a buyer. All right. Side note, notice how one deviation of this lines up perfectly with the high of this candle, which is the lowest down candle in that range right there. Just a side note. So at this price, at the red line, if you had any anticipation that price could potentially start another round of buying from here, what you could do, this is all hindsight, is have a limit set around an area that gives you the most confluence. In this case, we have one deviation down plus the order block right there. Order block opening price is right here. So let's just line that up with a potential area that we could put a limit and then have our stop loss based on spreads. Let's say 2 pips below this low. Throwing it for a nice 6.2, let's call it 7, for a nice 7 pip stop loss. So before price gets here, you have an idea of where you plan to enter, how you're going to frame your risk. Now, the only other thing you need to focus on is where do you get out of this market? Okay. Here's the Asian range. This is a range. If you look at the structure of this range, you should see, if you have been watching my videos for any time, this drop, then a pullback, then another push down, right? So this is my type 2 sell setup, where you're going to wait for price to trade back above this high right there, and you're going to sell up here. Now, if you're selling up here, logically, your next area of target would be below the lows, because we understand that liquidity is being pulled here, and the fact that this low is also pulling liquidity. So these are relatively equal lows. Okay. So with that idea, let's clear all these arrows. And let's frame our trade plan exactly at that high. So before price actually does any of this, right? This is the important part. Before price does any of this, what you have here is a plan, all right? This is a plan or a model, if you will, for what your next trade should look like. We have the Asian range information. We have one deviation down of the Asian range that coincides with a bullish order block. So we want to see if price gets here. If you're watching this real time, if price gets here, you would not want to see price close below this candle, as that would invalidate your setup. If price gets here and it's not closing, then you can enter Live market conditions, enter here. You know where your take profit is, you know where your stop loss should be. And that's your trade, right? If you don't have time to do that, then you have to make peace with the fact that you are not perfect and you can be wrong. If you are wrong about this idea and you're going to set a limit, you have an area where you will be putting your stop loss. If this 7 pips is too much or too wide a stop loss for your preference, then if you're going to participate in this trade, reduce the risk by cutting your stop loss, by cutting your lot size. You're never, ever going to be 100% correct at any point in time. You're going to take losses. You're going to enter here for a buy, and then it's going to just sink against you. These things are going to happen. When these things happen, how you control the emotions that everyone has from losing is to control the losses. And how you control the losses is by keeping your risk managed, reducing your stop loss, reducing your lot size. Both of those are key elements that you can use to manage the risk. Now, if you see that this is potentially going to be a type 2 setup and you don't trust buying in here, then you don't have to buy here. Instead, what you can do is anticipate that when price gets here, you don't really care what it does here. The only thing you're now focused on is once it trades back above this up candle, you're going to go short. And as usual for Confluence, we have an order block right there, ICT order block right here, above that area where you're anticipating price to trade back to. So the same thing, you could be interpreting this move from the short side. You're going to be entering at that order block, put your stop loss 2 pips above, so let's round it off to 6 pips. And your target logically is going to be this low and this low in a best case scenario. So let's pull it all the way down to that low right there. This is what the trade looks like, or this is what the trade idea looks like. How you frame your risk, where do you decide to get out, where you decide to take partials, that comes into your personal trade plan. Do you only take 3-to-1 setups? Are you only going to be looking for 20 pip trades? Whatever that is, that's a part of your own personal trade plan. Now, we just framed 2 ideas, one on the buy side and one on the sell side, both offering roughly about 20 pips each with minimal risk. Nothing here, this is hindsight, but nothing here is cherry picked. These are actual trades that I know persons who took them. I didn't take these trades. I'm not trading. I haven't traded EU all week on a live account, but these are trades that I know persons have taken. Now, I don't want to focus too much on trade idea because I want this to be a beginner, essentially a beginner video, right? So with that in mind, once you've accepted that there is an algorithm that's moving price around, the next thing you want to make peace with is the fact that everything that you see here on a chart is engineered. The range in Asian wasn't randomly created so that you could pick random levels in Asian. One deviation doesn't line up with a random level, right? Nothing on this chart is random. So if you accept that nothing on a chart is random, then you need to make peace with the fact that if you do an analysis and your analysis takes you to an area on a chart where nothing there makes sense, you need to do nothing. That's the most important thing that most traders who start out struggle with. You understand the potential that this can give, that trading can give you. So you're eager to do something, right? Because you're eager to do something, you end up forcing trades. And once you start forcing trades, you'll either develop bad habits where you do something completely stupid and you win. So now you're convinced that this works. So every time you keep trying to do this, sometimes you win, sometimes you lose. When you lose, you don't know why, but you still believe that this, whatever it is going to work. So for persons who have followed me, then as far as deviations go, you know that I use 1 deviation down and 3.5 to the upside, right? This is something I made known a while ago. So there's nothing here that I'm using that's cherry-picked. With that in mind, this is what a perfect scenario looks like. Price trades down 1 deviation, then it rallies 3.5. Because we know that this is what the delivery should look like, I have adopted a process where instead of forcing it to look like this, I focus on how many deviations create this. In this case, would have been 1, 2, 3, 4, 5.5 of this range should frame what I'm looking for. Okay, so when price trades lower like this, this is now down 2 deviations. Because this is down 2 deviations right there. My objective is going to move down 1 deviation. So if I take this box out and I adjust this to here, the length of this range still remains at 5.5. So entering here is going to give me a target based on deviations alone of right there. But deviations are just measurements on a chart. We know that time and price is what needs to align. So when my deviations give me this range as an objective, because this we would have already seen price trade down to this low. When we're anticipating a push higher, we expect the draw to be this level. So once we find this specific price level, 1.3386, we go to a chart. And depending on what type of trader you are, you can cycle through time frames. You can cycle through time frames to find levels that overlap with this blue line. So you could, let's say, hop to a 30-minute chart. And then on a 30-minute chart, again, based on what your personal model is, if you don't see anything here, go to a 1-hour chart. And you look until you find something that gives you confluence that you can overlap with this blue line. Now, on this time frame, I'm seeing this here as a structure that ICT talks about in his market maker series. I think that's in the 2nd or the 3rd one. I'm not sure, but you can check it out. Where he speaks about there's two types of reactions he likes to see when price trades to a higher time frame level. You can go ahead and check that out. On this time frame, it doesn't matter what time frame. Let's go back to the 50-minute time frame to remain consistent. But what I'm seeing on this time frame is this big fair value gap. Okay, let's go back to the 50-minute chart. So where the blue line is, I am seeing that big fair value gap. So remember that price, 1.3386. I'm going to take this blue line off. I'm going to adjust this line now for low hanging objectives, as ICT teaches them, where you get out of the market before it gets to a target. So you don't have to wait for price to be going against you to take profit. You think the market is going to go here? As it's getting to here, you want to be coming out or taking off most of your positions. Because most persons, I think it's because of greed. If you're in a buy here and price is moving up, they don't take profits as price is moving up. They'd rather wait for their profits to be going down, and then you get afraid of missing the move or afraid of missing out. So you start taking your profits then. I think it's better if you outline a move like this, and as price is showing you that you're correct, that's when you're getting out of the move. So here's ICT fair value gap that overlaps with our deviation levels. Not perfectly, right? Not perfectly. The deviation stops here. The fair value gap is here. So as price trades into this level, you can be looking to take all or most of your trades off. Now, what we've now outlined is where the area of opportunity should form from your next setup, right? Between here and this blue line. You still need to have an entry plan or an entry model before you start trading random levels. Why should this level support price? All right, stuff like that. Now, if you go to this blue line and we zoom in a bit, we can see that price was coming down, broke below this low, up candle in here, up candle, broke below these again, and then that push would have been that shift in the market structure. Whenever that happens, I go back to the turning point or swing low in this case, and I see this down candle right here. This candle is the lowest down candle in the swing low. So we outline all of that. I'm stretching this across so you can see the reaction there. And this area is where I'll be interested in being a buyer. So when it comes back here, this is a trade that I would take. Moves away. Gives a really nice move. Now, when this move happens, we now have a portion of our range or forecasted trading range that's not yet filled. So we now have this part of the move. Let's change the color to right there. We now have this part of this entire move from down here to up here that has not yet been fulfilled or has not yet been delivered. All right. So with that in mind, you're going to keep this area in focus, and you can do one of two things. You can wait for price to trade up here, and then if we're not aggressively closing above, you can look for going short. Or retracements, they don't always come all the way back down here, but when there are retracements, you can look for retracement entries to continue to get back up here. Order block, huge breakout structure, Asian taken out, comes back down to the order block, not closing below. You can look to be a buyer anywhere in here. Where's your stop loss going to be? Where do you consider yourself to be wrong about this move? If price is going below here, that's where you consider yourself to be wrong. So if that's where you consider your analysis invalid, that's where you should focus on putting your stop loss. So what this does for you or anyone who's trading is, if this is where my stop loss, this is where I consider myself to be wrong. So let's move that blue line down a little bit. That's where I consider myself to be wrong, right? What's the max amount of pips I want to put on a stop loss? If your answer to that question is 10 pips, then you know that you can't be entering before 10 pips above this blue line, which would have been 12830. Should have been somewhere in here, somewhere above here. You can find that for yourself. If your max stop loss, you want it to be 10 pips, you cannot enter above here, or it's going to force you to assume more risk in hopes of making more money. And that's a fallacy. You want to keep your losses as small as possible. So two important things for beginners here so far is, number one, the algorithm controls price, and it will always look back for reference points and use those as projections to get to the next target. Number two, risk management, trade management. You don't want to be afraid of missing a move. That's what kills everybody, and everybody knows this. FOMO kills, but it still kills people every single day. Why? Because we have not fully accepted the fact that we can lose and we will lose trades and we will miss moves. But having clear rules in play, that will help you to eliminate some of all these mistakes that most persons make. I want my stop loss to be maximum 10 pips. I will not enter above 830. So let's put some context there. 830 is right here. Let's get this line off. I will not enter above 1.2830. All right. So if I'm looking at entry, I'm looking at entering at this order block when price is coming down. But why should this order block hold? I don't see any reason for this to hold. There is a big push and I like that. But then there's all of this in here that price can trade back to. So if you enter in here and you put your stop loss, let's say below this order block, and you get stopped out, do you call that the end of the move? No, because price hasn't traded below here. When we get below here, that's when you want to start saying that this analysis is wrong. I'm no longer going to be looking for buys unless I see something else that aligns with my plan. With that idea in mind, if you say I'm not going to be entering above here, when price drives below here, if this satisfies your rules, you could have an entry here. If not, comes down here again, these could both be your entries. Stops below here, that's off to the races. Now, if you enter on this low here and you frame like a dollar amount to your risk, you don't want to lose more than $100 per trade. $100 with 10 pips is one lot, right? So if you enter here and your stop loss is now less than 10 pips, if my math is correct, that's about 7 pips in here, right? If your stop loss is 7 pips here and you can control the bleeding, put a one lot here, you're now risking $70. When this comes back down here, if you'd like to take this and assume the same risk of losing no more than $100 per trade, you could put a lot size here that allows you to lose only $30 if you get stopped out. So if you get stopped out of both trades, your risk remains the same. That is accepting risk. Positioning your trades so that if you are wrong, your risk remains the same. We can all see how this played out. Completely fills in the fair value gap and then it tanks from there, right? So that trade idea is, I mean, it's hindsight, but using just rules alone, we're able to frame out this right here. So keeping the focus on beginners. What I've just given you is enough to start getting your gears turning. The algorithm is always moving price. It moves price by looking back, finding ranges, projecting ranges. That's what I believe. That's what I accept. There's nothing that can change my mind about this. Okay? But I'm showing you what I can do with this information. And this is the bare bones of it. Projections is what I use to frame all my targets. For Confluence, as an ICT student, I will overlap ICT concepts with projections. And that gives me a whole lot of confidence in my setups. Because if I know that, or if I understand that order blocks are really powerful for trade entries, and I get a deviation that aligns with an order block, and price comes back to that order block at a time of the day where my trade plan allows it, then I'm golden. All right. Another distinction I want to make for beginners is that trading a trade model and a trade plan is two different things. A trade model simply outlines your entry pattern, your exit pattern, and that's it. That's your model. What do you use to enter? What do you use to exit? Your trading plan, however, will dictate what your risk is like. How many positions do you put on per trade, per setup? What time of the day do you trade? What days do you not trade? Those are part of your trade plan, and those are what makes consistency. It's more, I can't find the word, but with a set trade plan, it keeps you out of the market and tells you when to go in the market. So you use your trade plan to filter out setups from your model, right? So let's say your model is type 1 or type 2 entries, right? Based on those two entries I shared. Your trade plan will tell you, don't look for type 1 or type 2 when there's news, or don't look for this at this time of the day. Whatever that rule is for you, that's how your trade plan comes together with your model. Okay, so I think this video is getting a little bit too long. I'm going to end this here, and until the next time, wish you the best in your trading, and we'll talk again.